Hello, and welcome to everyone joining us today from different corners of the country to discuss navigating the complex student loan landscape. I'm Linda Williams, Community Outreach and Training Manager at Consumer Action, and I am so excited to be your facilitator today. Before we get into the training, let me pause to thank our sponsor. Consumer Action is present this webinar with funding from Wells Fargo. Wells Fargo has been a fantastic partner, and at Consumer Action, we appreciate their support. Now, if you're joining us for the first time, let me introduce you to Consumer Action. We are an educational advocacy organization. Through our multilingual financial and consumer rights education materials, community outreach, and focused advocacy, Consumer Action ensures that every underrepresented consumer have the knowledge and resources they need to assert their rights in a confident manner in the marketplace. We're excited to announce that this November marks a significant milestone for us. 35 years in the business, helping consumers on a wide variety of kitchen table topics, whether it's navigating the complexities of auto lending and insurance, finding the right job training program, or managing student loan debt. Consumer Action has been a reliable partner for consumers throughout their financial journey. Now, when you're on our website exploring, please make sure not to miss our events section. That's that little reddish look square up at the top of your screen. There you'll find information about upcoming events, including in-person trainings that may be happening in your backyard, in your community. These sessions are invaluable opportunities to learn, connect, and network, and they are free. Now, before we dive into the main topic, let's quickly cover some housekeeping details. For the next 90 minutes, we will engage in a discussion about the current state of student loans in America and explore strategies to help consumer loan debtors navigate this complex and ever-changing landscape. Our expert speakers will present in the order they are introduced. The PowerPoint slides used by each presenter will be available in 1 week, no later than April 24th. So mark April 24th on your calendar so you can remind yourself to check your inbox. This webinar is being recorded and it will be posted on our YouTube channel. You will receive a link to the recording and several handouts regarding the student loan crisis, also by the close of business on April 24th. Our final speaker is Khandice Lofton. After her presentation, my colleague Nelson Santiago will lead a question and answer segment. We value your input, so as we progress through each presentation, please don't hesitate. In fact, I encourage you to use the question function on the dashboard to submit your questions. For those of you who are seeking AFCPE credits, the password will be provided at the end of the webinar, so hang in there with us. Lastly, we ask that you complete a survey regarding the webinar at the end of the session. Again, your feedback is valuable to us. We appreciate you taking a moment to share your thoughts before you disconnect. Now, without further ado, let me introduce you to our fantastic experts. Sara Wilson is the Director of Product Innovation and Marketing at Student Connections, where she leads cross-functional teams in developing and promoting solutions that support student success in college and beyond. With more than 19 years of experience in financial education, project management, and communications, she has designed and launched outreach platforms, mobile responsive financial education tools, and data-driven communication strategies that enhance student outcome. Milo Schaberg is an attorney at Loftless East LA office, is working on issues related to federal and private student loan. He assists low-income student debtors with repayment, discharge, and forgiveness options for their federal loans. He also defends private student loan debtors in debt collection lawsuits brought on by those debt buyers. Khandice Lofton is at counsel at SBPC, Prior to her tenure at SBPC, Khandice was the staff attorney at Legal Aid of West Virginia, where she represented low-income consumers in a variety of civil cases involving housing, divorce, child custody, and unemployment issues. Khandice joined Legal Aid of West Virginia after graduating from the University of Dayton School of Law in May of 2021, where she was a recipient of the Brother Raymond Fitzgerald Student Leader for Justice Award and a Graduate Student Showcase Award for outstanding community service. Very special welcome to all of our speakers. Now, as I turn this presentation over to Sara, I want to ask Sara if she will take just 1 minute before diving into her presentation to talk about Student Connections, because I'm assuming half of you on here have never heard of Student Connections and the great work that they're doing. So Sara, please, before you dive into your presentation, give us a little background on Student Connections.
Happy to, Linda, and thank you so much. So I have the pleasure of kicking things off today, and as we talk a little bit about Student Connections. So Student Connections is a company that works with colleges and universities to help student loan borrowers navigate student loan repayment. So schools contract us to provide support and services to students, ultimately just to help them figure out what options they have available to them, help them navigate working with their student loan servicer, and finding a repayment solution that works for them. We don't charge borrowers for our services. We are contracted by the colleges and universities that those students attended school at. We also provide enrollment outreach services, financial education, and debt letters on behalf of colleges and universities to student loan borrowers. Does that give you a little bit of an introduction there, Linda? Is that good enough?
Perfect. Absolutely perfect.
All righty. So I am trying to take control here. There we go. All right. So as I mentioned, it looks like my slides are catching up with me now. Okay, so I have the pleasure of kicking things off today, and I'm going to start by talking specifically about the recent legal developments surrounding the SAVE repayment plan, what that really means for borrowers, and the things that borrowers can do now to navigate repayment options as they move forward. All right. So since it was introduced, the Saving on a Valuable Education, better known as the SAVE plan, has undergone significant development as well as legal scrutiny. And with things being kind of up, down, and all around, I wanted to start off by reviewing some of the key milestones and setbacks that led to where we are today. And just forgive me, it's a little delayed there on my slide advancement. Okay, so starting out with when the SAVE plan was originally announced on June 30th, 2023, it was designed initially to replace the repay plan, which was at the time the most affordable income-driven repayment option for federal student loans. The goal of SAVE was to reduce monthly payments for some borrowers as low as $0. It was to offer faster loan forgiveness for low balance borrowers and to eliminate the unpaid interest accumulation for borrowers. So if they, if their monthly payment essentially wasn't enough to cover the interest that had accumulated, it would allow them to not just have their loan debt grow and grow and grow at a time while they are on that repayment plan. The final rule was published just a few weeks later, officially establishing the SAVE plan and as well as updating the terms for other IDR plans. In August of 2023, a few of the SAVE features went into effect early. That included the discretionary income threshold, which was increased from 150% to 225% of the federal poverty level. And it also, they went ahead and introduced that interest subsidy, meaning that borrowers making full payments wouldn't see their loan balance grow beyond what it was when their payment was due. Borrowers were able to start enrolling in the SAVE plan starting in October of 2023. And then in January 21st of 2024, the Department of Education began offering early forgiveness under the SAVE plan for borrowers whose loan balance was $12,000 or less, essentially their original loan balance. So borrowers who borrowed less than $12,000 were able to see income-driven repayment if they had made 10 years of qualifying payments. And then on July 1st, 2024, all of the remaining SAVE features were launched. And so between its introduction to this point, nearly 8 million borrowers had enrolled, which is unlike any other non-standard repayment plan that we'd ever seen in federal student loan history. So fast forward, or jump ahead, only 18 days later, a federal appeals court issued a temporary injunction, which ultimately halted the SAVE's new forgiveness provision. There was a case that was brought in, and the court ruled citing potential overreach of executive authority. And this essentially put everything on pause. So on August 9th, the 8th U.S. Circuit Court of Appeals went ahead and provided an initial injunction or ruling. They expanded the injunction to block the entire SAVE plan, as well as they limited borrowers' access to other IDR plans that had forgiveness components. Ultimately, what they found is the Department of Education had exceeded its legal authority under the Higher Education Act. And Ed did attempt to have SAVE reinstated by appealing to the U.S. Supreme Court. However, they refused to hear the case, citing a need for further deliberation at a lower court level. And so ultimately, this just upheld the Eighth Circuit ruling and created a nationwide block for the SAVE plan. Put everybody who was in SAVE into forbearance, and it made access to other income-driven repayment plans unavailable for the time period. Just a couple of months ago, so earlier this year, on February 18th, 2025, there were two major developments in the cases. And the Eighth Circuit Court of Appeals ruling was reaffirmed. They ultimately declared that SAVE forgiveness provisions were unlawfully implemented. They also invalidated older forgiveness rules under the repay plan. And they emphasized that only Congress has can authorize the large-scale forgiveness that was in play for these plans. So in response to the ruling, the Department of Education did have to remove access to the IDR application to comply with that injunction. Just a couple of weeks ago, on March 26th, the Department of Education released a revised version of the IDR application, and now borrowers can once again apply for income-based repayment, pay-as-you-earn, and income-contingent repayment. All right, so now that we have a final ruling, we have clarity. Kind of. The direction is clear, but the fact that things have changed may lead to confusion. And so I'm going to give a quick rundown of how the most recent court actions differ across the IDR provisions. So between the final rule that was published on July 10th of 2023, the initial lawsuit ruling in August of 2024, and now the final court ruling in February of 2025, here are the things that have changed. Starting off, the July 10th rule that introduced the new SAVE formulas. That included the reduction of payments to 5% of discretionary income for undergraduate loans, as well as it raised the income exemption to 225% of the poverty level. And effectively, it replaced the repay plan. The initial court ruling allowed partial implementation, but most of the most recent ruling freezes all of these changes. So borrowers can't access the SAVE plan. They also can't have access to repay's prior forgiveness terms because those were invalidated. So that's where things stand on the SAVE and repay monthly payment formulas. The regulatory changes that were proposed in 2023 rule also aim to standardize when a borrower's spousal income could be used or their loan balance in terms of when it was used for calculating the monthly repayment under an income-driven repayment plan. So for example, under the SAVE plan, borrowers who filed taxes separately were able to exclude their spouse income, whereas borrowers that were married and filed jointly would have their spouse income included in the calculation. And the rule essentially was just trying to standardize that across all of the different income-driven repayment plans to provide a level of consistency for that borrower benefit. All of those changes were also now frozen. All right, so then also under the July 10th rule, the interest subsidies to prevent unpaid interest from growing, or there were interest subsidies introduced to prevent unpaid interest from growing. They also wanted to accelerate forgiveness for those low balance borrowers. I mentioned earlier offering cancellation after just 10 years of qualifying payments for borrowers who had less than $12,000 or borrowed less than $12,000 to begin with. And while the earlier ruling only paused the new forgiveness on the save side, the most recent ruling blocks all forgiveness provisions across the repay plan, the pay plan, and income contingent repayment plans. It also all halted the rule allowing certain deferment and forbearance periods to count towards forgiveness, which had previously gone unchallenged in the earlier ruling. All right, so then to wrap up this section, I wanted the two kind of final borrower protections that were in the July 10th rule that I wanted to highlight here are that the July 10th rule ensured that consolidation loans would retain credit for prior payments using a weighted average. And it also allowed borrowers who had resolved a default or a defaulted student loan to regain access to income-based repayment. The earlier court rulings didn't block either of those provisions, and borrowers were still seeing those benefits. However, the most recent ruling does freeze both of those. Essentially, that means that your consolidation, if you consolidate your loans, it may now reset the payment count. And then borrowers that are coming out of default are likely going to lose access to income-driven repayment plans unless new guidance is issued. So just to summarize where things stand today. SAVE can't be implemented and will no longer be pursued. If you applied for SAVE and your application was approved, you should still be enrolled in the SAVE plan. Your loan should be in a general forbearance, just means that you don't need to make a payment and your debt is not accruing any interest. The other thing is that none of the provisions in the Department of Education's July 2023 rule can be implemented. That most recent court ruling invalidated all of that. The income-driven repayment applications were temporarily unavailable, but they've been brought back. They've had some updates, so SAVE has been removed from that application. As of March 26th, the online application is available, and borrowers that are eligible can apply for either income-based repayment, which is IBR, pay-as-you-earn, and income contingent repayment plans. We had just an update as of yesterday. So originally this said that the IDR applications weren't yet being processed. However, servicers started processing those applications for borrowers who file taxes as single or married with no income, according to MOHELA's website. Also, according to the Department of Ed in a memo yesterday, they expect that servicers will fully resume processing the income-driven repayment applications by May 10th. Just a word of, I guess a heads up, word of caution, there is a backlog of applications and it is going to take time. So if you are someone who has an application pending or you submit one soon, just expect it to take a little while before the servicers can get through the backlog that they currently have. I also want to take a minute and talk about how the recertification timelines might affect borrowers that were on income-driven repayment plans and expected to recertify at a time when the online application wasn't available to allow for that recertification. So if you are a borrower that has a recertification and that was due by on or before March 17th of 2025, and you submitted your request by February 20th, you should be in good shape. There was no impact if your application or your recertification was already processed. If it hasn't been processed, good news is your deadline was extended by 1 year, gave you some more time essentially for the paper. They're not going to punish you for the fact that the application wasn't down and you didn't have the ability to recertify or it didn't get processed yet. However, if you were someone who had that recertification that was due and you did not submit it by February 20th, you were likely placed on a temporary non-income driven based repayment plan. And that means that if you want that lower payment, or if you want to find a new income driven repayment plan, you're going to have to start the application process over again. For borrowers who had a recertification due date that was after March 18th of 2025, your deadline also was automatically extended. That said, there were some borrowers that were incorrectly moved to a higher non-income driven based repayment plan. And servicers are actively working to correct that. So it's really important that if you're in a situation that you figure out where your loan status is right now, and make sure that if you are someone who was moved out of a plan, that you're keeping an eye on the fact that the servicer is getting you back into the correct plan. And then finally, if your recertification date is February 1st or 2026 or later, your timeline hasn't changed, you still need to recertify by your original deadline. And as always, just log in to studentaid.gov to check on your recertification status and keep up to date. All right, now that we've covered what's changed, I'm going to try to get that mouse out of there. Let's shift to what you can do next. All right, so your specific steps are going to depend on your situation, but there are a few actions that really every borrower should take right now to stay on track. First, log in to both studentaid.gov and your loan servicer's website to confirm the status of your loans. Don't assume anything. Don't assume everything's in order. You need to check your repayment plan. You need to see if you're in a deferment or forbearance. You need to confirm that you are not currently past due on your monthly payment. Even the smallest errors on your account can lead to consequences if they're left unaddressed, and you need to be the biggest advocate for yourself and look at your information and make sure you have a clear picture of where things stand. Next, you need to make sure your contact information is up to date. That includes your email, your phone number, your mailing address. If your servicer can't reach you, then you may miss critical updates about your account and things that are, things that you need to know and actions that you may need to take. Also want to just give everyone a heads up to be on the alert for scams, because unfortunately scammers are taking advantage of the current confusion. This situation has been evolving. It is taken turns left and right, and scammers thrive in that situation where you may call and say, hey, I've got loan forgiveness for you. If you just pay me this small fee, I can get you a guaranteed loan forgiveness. I'll just tell you right now, that is not how loan forgiveness works. So if you are being contacted by someone you don't know, make sure that you only trust information from those official sources. Look for, make sure you're looking at the Department of Education's website, your loan servicer's information. Look for messages from your former school or companies that are contracted from your school, kind of like the company I worked for, Student Connections. We're contracted by the school to contact students and to support students and help them navigate the complex map of student loan repayment. And finally, just don't believe everything you hear online, everything you read on social media, even everything you hear in the news. There is a lot of misinformation out there right now. This is I guess an unprecedented situation. We haven't seen things like this happen. And so there's just, the intention may not be to misguide or misdirect, but the misinformation is out there. So just verify that the information you have is, verify it from a trusted source like the Department of Ed or your loan servicer or your school before you take any action. All right, so borrowers that are in SAVE, if you're currently enrolled in SAVE, your loans, as I mentioned earlier, are likely in a general forbearance. And according to the Department of Ed, that forbearance is expected to last through at least September of 2025. And that means that your first payment likely will not be due until December 2025 at the earliest. That said, you won't be able to stay on the SAVE plan. That plan is not able to be operated, so you're going to have to switch to another repayment plan at some point in the near future. Use this time to look at what those other income-driven repayment options are, like income-based repayment or pay, or consider plans like graduated or extended if they're a better fit for your budget. Ultimately, no matter what plan you choose, it's smart to start planning for repayment now. You need to work your student loan payment into your budget so you're not caught off guard when those payments resume. Most people can't just automatically start making a payment that they weren't making. So this gives you a little bit of time to build up some savings, get into the routine, make some adjustments in your spending plan if needed. Also be sure to watch for updates from Department of Ed. They will post their updates to studentaid.gov as well as send email notifications as new guidance is finalized. Mentioned earlier that part of the court ruling was indicating that the changes that were implemented lacked the authority, and they're really encouraging Congress to take action to solidify some of these repayment plans going forward. And so as changes happen, whether it's at the level of Congress or whether that happens at the Department of Education, they will keep their website up to date and they will push information to borrowers that have loan balances. If you do switch to another income-driven repayment plan, I recommend that you go ahead and proactively set up your automatic IDR recertification. Essentially, save yourself the time and effort. It will make sure that your income and family size get updated each year automatically, rather than you having to manually do that and ultimately run the risk of forgetting to do that and then having your loan come out of that income-driven repayment plan and increasing your monthly payment. Also, just a quick note for borrowers who are pursuing public service loan forgiveness. This is the period of forbearance. If you're on the SAVE plan, this period of forbearance under the SAVE does not currently count toward the payment count for PSLF. There are some options to regain those payments, those missed payments. You can either change repayment plan to a different income-driven repayment plan that does count so that your payments are actively counting towards PSLF, or you can use the buyback credit. If this applies to you, I just want to say, review your options carefully. Make sure that you look at those options, understand the impact of those decisions before you make any changes, and I would consult your loan servicer for if you have any questions. All right, let's talk about those borrowers who had an income-driven repayment application that was currently being processed. If you submitted an application before February 18th when the court ruling occurred, you're likely in what's called a processing forbearance. That just means that you don't have any payments that are due right now. However, that interest may still be accruing while your application is being processed or being reviewed. If your application was accepted more than 60 days ago, you may have been moved into a general forbearance. So if it takes more than 60 days for the loan servicer to process your application, they'll move you into a general forbearance. And what that means is you're still not required to make a payment, and now that interest is no longer accruing. But keep in mind, this is still a temporary status. I think the most important thing is to stay on top of your loans during this time. I recommend that you check your accounts monthly to see if your repayment plan or forbearance status has changed. And as always, watch for those official emails or updates from your loan servicer or from studentaid.gov, because they will let you know when it's time to take action. And finally, just as I said to those borrowers that are in SAVE or to all borrowers, use this time right now to prepare for repayment. Those payments are expected to resume in winter of 2025, and the more prepared you are now, the smoother that transition will be to successfully begin making those monthly payments. All right, the last group of borrowers I just want to acknowledge and talk to directly is those of you who maybe aren't on SAVE, aren't on income-driven repayment plans, but you're struggling to make your payments and you need a way to either lower or pause your payments, and maybe you haven't had as many options available to you while SAVE has been tied up in court. So if you're struggling to make your payments, the most important thing to do right now is to know that you have options. And the worst thing you can do is run and hide. You need to take action. You need to contact your loan servicer. You need to look at your options and go ahead and get in either pause or lower your payments. So starting off, log into studentaid.gov or your loan servicer account. Make sure you can access everything. Make sure you find your up-to-date information, what your loan balance is, what your repayment plans are, as well as what options you have available. The next thing I want you to do is write out the challenges you're facing. Is it that your payments are too high? Is it that your income has changed? Is it that you've had a change in your job and you don't have an income and you just need a temporary fix? Having a clear description of what your problem is from your point of view will make it easier for you to research your options, but also to communicate and talk to your loan servicer. Then you can use that problem statement to start exploring your options and see what you might find. So for short-term relief, you might qualify for a deferment or forbearance. This would be a way to temporarily pause your payments. It can help protect your credit score. It can kind of, in a short term, buy you some time. However, just keep in mind that your interest is growing, which means your loan balance is also growing, and so it's not a permanent fix. If you're looking for more of a longer term solution, that's when you want to consider changing a repayment plan. Looking at other repayment plans like income-based repayment or graduated repayment may be able to reduce your monthly bill, and they weren't affected by that most recent court ruling, so they're not tied up in the same way. Really, no matter what your situation is, the goal is just to find a path that helps you stay out of your loans being delinquent and makes that loan repayment more manageable. All right, I want to just wrap things up by highlighting a few trusted resources before I turn it over to, I believe, Milo. So just wrapping things up. We know that this landscape has been really confusing and that things are really changing. And they're changing quickly. And that's why it's really important to rely on that official, reliable sources of information, tools, and guidance. So starting with studentaid.gov. This is the U.S. Department of Education Central Hub. This is where you can review information about your loans, you can explore your repayment options, you can use the loan simulator to compare your repayment plans, and you can enroll or recertify for income-driven repayment. As well as, this is where you would look as the Department of Education responds or gets updates responding to these legal developments. This is where they're going to include information. You also can find on their YouTube channel some short videos. It's really great for some step-by-step. If you need a guide on how to complete a step in the federal student aid process, check out the YouTube channel for federal student aid. The other resource I just wanted to highlight is, of course, your student loan servicer. They are your direct point of contact. They can answer your questions. They are processing the applications, and they're there to help you get on the right plan. And they do that at no cost to you. They're contracted by the federal government to service your loans. They are there to support you and make sure you have what you need. So it's really important that if you have questions, that's who you contact. If you don't know who your loan servicer is, you can find out by going to studentaid.gov and logging in there and looking at the My Loan Servicer section of your site. Or if you don't know how to log into studentaid.gov, you can call the Federal Student Aid Information Center and ask them, and they can help you get connected to the right student loan servicer. And I believe that is it for me. I'm going to go ahead and turn it over to Milo.
Sara, thank you. That was awesome. Milo, give me a minute. Let me give you, you should have control of the mouse, of the board. There you go.
Okay, looks like I have control.
Yes, you have control.
Let's see, I don't seem to be able to advance the slides.
Take the cursor around in a circle, push down. There you go.
Okay, there we go. Cool. So I'm going to talk about a few more specialized options for loan discharge and forgiveness. So Sara was discussing income-driven repayment plans, which are available to a large percentage of the population. The programs I'm going to be discussing are only available based on certain circumstances, but they can also be useful tools. So first, total and permanent disability discharge, TPD. This is available for borrowers who have a physical or mental disability or illness that substantially impacts their ability to work, and it's available for federal loans only. So can I advance the slide?
Try the arrow on your keyboard.
Yeah, I am. Let me see.
Well, just say next slide and I will advance.
Okay, sounds good. Next slide, please. Okay, so first of all, TPD processing has been paused, or it was paused for a few months since December 2024 to March 2025. This was a change that was planned for a long time prior to the current administration in order to basically update how TPD processing is handled. Previously, applications were submitted to a loan servicer, those loan servicers that Sara discussed, and they were processed by Nelnet, which is one of them. And now the applications are submitted directly to the Department of Education, and they're processed by contractors who are not loan servicers. Next slide, please. So the standards for TPD discharge can be a little bit confusing, and the way they're written, it's fairly ambiguous. So I wanted to dig into that a little bit more. So the statute says that a borrower is eligible for TPD discharge if they are unable to engage in any substantial gainful activity by reason of any medically determined physical or mental impairment. The term substantial gainful activity is a little bit unclear. The name total and permanent disability discharge gives the impression that the borrower needs to be permanently disabled and completely unable to work. But the way in which the program is administered, borrowers are not held to that standard. Substantial gainful activity means something like work that requires a significant amount of physical or mental engagement. But the Department of Education has made clear several times that borrowers are able to work and receive a total and permanent disability discharge. And they've made clear that the intention of this program is not to discourage disabled borrowers from working at all. So my best read of it is if a borrower is working to some extent, maybe if they're working part-time, maybe if they're working in a job that's not exactly what they prefer, if they've foregone other kinds of employment because of their disability, I believe they would be eligible for a total and permanent disability discharge. Next slide, please. Okay, so there's 3 ways of proving disability in order to receive a total and permanent disability discharge. The first way is medical professional certification. You would need certain medical professionals to sign a form for you, essentially. I'll get more into that one later. The second one is SSA determination. If you have disabled status through SSA, this type of discharge is generally automatic, but sometimes it seems like people slip through the cracks and they don't receive the TPD discharge, even though they have the correct status. So in that case, it's also possible to apply based on an SSA determination and provide evidence. And the third way is for veterans who have a service-connected disability, and that one is also generally automatic. Next slide, please. Thanks. So to talk a little bit more about the medical professional certification, because I think this is probably the most common one. So previously, it required a doctor to sign off, but this has been expanded to physicians, nurse practitioners or physician assistants, and psychologists. And so the way it works is there's a form that they need to sign. As of the most recent changes to processing, there's a way to send that form through studentaid.gov for a virtual signature. And that's supposed to be the most convenient and efficient way of doing it. And the form, the medical professional certification form, essentially requires them to list some of the symptoms, some of the effects on work, and to certify that the borrower basically cannot work right now and will not be able to work for a significant period of time due to a physical or mental disability. And so there's no exact standards for what counts. It seems fairly broad. It could be physical disability, it could be mental health conditions, essentially anything that a physician or other medical professional will certify to that is preventing a borrower from working or significantly impacting their ability to work. So the new process is to apply directly through studentaid.gov through the link I provided. Need to log into your studentaid.gov account, and you can either use the old method, which would be to print out the medical professional certification, bring it to a medical professional, have them sign it, fill it out, and then scan it and upload it, or the recommended method, which would be to send it for an e-signature. And the website states that a response will be issued to this within 3 days. I think that's a little bit ambitious. Probably more likely a month or two for a response to this. And I just wanted to say about TPD, unlike many of the other programs Sara discussed and I'm going to discuss, TPD, there's no announcements of any changes or alterations to the TPD program as far as I can tell, either regulatory or legislative. This is not necessarily something that the current administration is trying to change. And I think for borrowers who do qualify as having a TPD, this is probably the best option for their federal student loans. Okay, so the next program I want to talk about is public service loan forgiveness. Next slide, please. So just to go a little bit into the history of public service loan forgiveness, this was a program created in 2007. The intent was to essentially grant borrowers who worked for government or for nonprofits loan forgiveness after a certain period of time in order to encourage them to work for governments or nonprofits. The idea is they'd be foregoing probably better paying work for private organizations in exchange for having their loans forgiven after a certain period of work. And the program provides for total loan forgiveness on eligible federal student loans after 10 years of working in qualifying employment. So the program began in 2008. The first group of borrowers became eligible in 2018. However, historically, there have been some pretty serious issues with the way the program has been administered, making it extremely difficult for anyone to receive public service loan forgiveness. Just problems with certifying employment, problems with certain months not counting. So as of April 2018, out of 19,000 qualified applicants who applied, only 55 were granted PSLF. But a new set of regulations regarding PSLF in 2023 expanded eligibility and made it easier to qualify certain months towards public service loan forgiveness. Next slide, please. Okay, just to talk a little bit about the requirements for PSLF. So there's 3 main requirements: qualifying payments, qualifying loans, and qualifying employment. So as I said, it's 10 years to receive public service loan forgiveness, so 120 monthly payments, and only certain types of payments qualify. So if you're on any income-driven repayment plan, such as SAVE, PAYE, ICR, or IBR, not SAVE currently because nobody on SAVE is making payments, but any income-driven repayment plan payments, those count towards public service loan forgiveness, no matter what the amount is. And then outside of that, if you're not on an income-driven repayment plan, you essentially have to be on the standard plan. So the way the PSLF program works, a payment counts as a qualifying payment if it is equal to or above the standard plan payment. But also, standard plan repayment is usually devised to repay the entire loan amount within 10 years. So public service loan forgiveness is also set to forgive loans after 10 years. So if you are on standard repayment the entire time, there would not be anything on the loan to forgive. So in general, public service loan forgiveness is probably only beneficial for those on income-driven repayment. And then there are also a few other types of repayment aside from these two, such as graduated repayment, but those generally have lower monthly payments than standard repayment. So those would not count towards PSLF. And the second requirement is qualifying loans. So only direct federal loans qualify for PSLF. Only those can be forgiven through the program. This includes PLUS loans, but private loans are not included. So in the past, I would have said that if you have, for example, FFEL loans, older loans, those loans can be consolidated to create PSLF eligibility. But as I believe Sara mentioned, consolidating loans is very risky right now in terms of income-driven repayment. Part of the SAVE regulations that were enjoined created a weighted average system for consolidation loans, meaning that if you had made many months of payments that would move you towards income-driven repayment forgiveness on your underlying loans, you would get a weighted average of those on your new direct consolidation loan. Now it's very unclear whether that will still be happening, and the Department of Education is currently saying that there will be no weighted average on consolidation loans. So if choosing to consolidate loans to create PSLF eligibility, you would likely be giving up all of your credits towards income-driven repayment, and your direct consolidation loan would start from zero. So that can be a big risk, and that's really something to think about before deciding to consolidate at this point. And the third requirement is qualifying employment. So you must be working for a government, state or local, or a 501, or state, local, or federal, or a 501c3 nonprofit for each month of making payments, right? And you must be working full-time, which for the definition of PSLF means 30 or more hours per week, and it must be paid work, right? So you can't volunteer for a nonprofit for 30 hours a week and get PSLF eligibility that way. Okay, so each month must meet these requirements, right? Each month must be an IDR standard payment on a qualifying loan while working in qualifying employment. So if you meet those three criteria, then that month will count towards your 120 months of PSLF forgiveness. So after you hit 120, at that point you can apply for PSLF. And one more detail is that even if you hit 120, say years ago, you must still be working in qualifying employment at the time of applying. So sometimes you'll see people who want PSLF just start working briefly for a nonprofit in order to apply, because that is a requirement of the program. Next slide, please. Okay, so there have been quite a few changes and disruptions to PSLF recently that I wanted to discuss. So the SAVE lawsuit and injunction that Sara discussed, this didn't speak directly on PSLF in any way, but it did impact it indirectly. So many borrowers were on the SAVE repayment plan, and then due to this injunction blocking the implementation of SAVE, these borrowers were placed on a general forbearance. These general forbearance months do not count towards PSLF by default. And then in February of this year, the Eighth Circuit Court of Appeals expanded the preliminary injunction, and the Department of Education responded by removing IDR applications. So at that point, borrowers who wanted to switch out of SAVE became unable to switch out of SAVE. So in other words, there would be no way for those borrowers to start getting PSLF credits, even if they were willing to make payments and working in qualifying employment. And then in March, IDR applications were restored, but they still aren't being processed. And as I believe Sara mentioned, there's going to be a big backlog once they start being processed. So I've heard they'll start being processed again in early May, but who knows really when they will complete their backlog and when people who applied for, say, IBR from SAVE will get onto the IBR program. Okay, so I wrote here that it's unclear whether the buyback program is still operating. There's been updates in the last day or two. In one of the cases, the Department of Education is defending right now. They filed a declaration stating that PSLF buyback was still operating. So I want to explain PSLF buyback a little bit. This was a program that I believe started in 2023, and the idea was for borrowers who had qualifying employment and qualifying loans, but didn't make a qualifying payment for that month due to being on forbearance or deferment that wouldn't qualify, they would be able to buy back that month. So that means they would make the payment that they would have made on their IDR plan at that time, and they would be able to buy back that month. So they would be able to get PSLF progress for that month. So the declaration says that this will apply to administrative and processing forbearances. At this point, it's still unclear whether the PSLF buyback will be available for time on the SAVE general forbearance. They didn't specifically say whether the general forbearance would be counted. There's some indication that wouldn't count as a processing forbearance due to the differences in interest, but it's unclear at this point. But it does seem that PSLF buyback is still operating. Next slide, please. Okay, so one other major change to PSLF recently, or at least an announcement of a potential change. There was an executive order discussing PSLF, and this executive order directed the Secretary of Education to propose revisions to the PSLF regulations in order to change the definition of public service to exclude organizations that engage in activities that have substantial illegal purpose. There's a few more details there. There's a few more specific things that are mentioned. As of this time, that executive order does not change anything about the PSLF program, as the Department of Education itself states on their website. And it is unclear whether that executive order could change anything about the PSLF program. PSLF itself is statutory, and the statute includes a reference to 501c3. 501c3, the definition of nonprofits, is also a statute, so it is unclear whether those could be changed without an act of Congress. The Department of Education has announced that they're beginning negotiated rulemaking about this topic, scheduled for April 29th, which I believe would be the virtual one, and May 1st, which I believe is in person. And they're also discussing a few other topics here. So the announced topics are PSLF, AE, ICR, and other topics that would streamline current federal student financial assistance programs. So they haven't provided much information about what exactly they're planning to change or discuss changing there. Regarding PAYE and ICR, most likely the idea would be to eliminate time-based loan forgiveness from those programs. Next slide, please. Okay, so we've only been discussing federal student loans so far, but I wanted to talk briefly about private student loans. due to changes in federal student loans and legislative proposals to limit the amount of federal student loans available, private loans may become a better option in the future. Next slide, please. Okay, so just to differentiate between federal and private loans, federal loans are subsidized or insured by the federal government. Private loans are extended by banks, credit unions, schools, or other organizations in order to cover educational expenses. And they're not subsidized or insured by the federal government. And that means they're not subject to the various loan programs that we've been discussing so far. So private student loans, unless the private loan servicer has their own program, which they rarely do, they wouldn't have access to total and permanent disability discharge. They wouldn't have access to public service loan forgiveness, and they usually don't have access to any form of income-driven repayment. It can sometimes be hard to tell whether a loan is federal or private just by looking at it, especially because some loan servicers service a large amount of federal loans and a large amount of private loans. But the easiest way to tell is to just check studentaid.gov. So if studentaid.gov lists the loan, then it is federal. And if studentaid.gov does not list the loan, then it is almost certainly private. There are some other ways to find out, such as debt validation requests or FERPA requests. Next slide, please. Okay, so as I mentioned just now, there is legislation currently being considered to reduce the amount of federal student loans that would be available. Some proposals are completely eliminating Parent Plus loans and other plus loans, and capping federal loans generally at a lower amount. So if these were passed, then it would make it more difficult for students to afford college education or graduate education, and it would incentivize private loans. Yeah, and especially graduate education, because that's what plus loans are generally used for. Okay, so I just wanted to discuss a bit the advantages and disadvantages of private student loans compared to federal loans. So the advantages of private loans, they can sometimes allow you to borrow larger amounts, and they're often used to cover costs above the annual federal loan limit, but this might be subject to credit. And then also federal loans, the government has incredibly powerful collection tools. For example, they can garnish your wages without a court judgment, but private loan holders or servicers don't have access to these tools. So essentially, aside from all the programs available for federal loans, defaulting on a federal loan can be more damaging than defaulting on a private loan. But there are also a lot of disadvantages to private student loans. Generally, they'll have a higher interest rate. They may require a strong credit score or a cosigner. As I mentioned, there's no loan discharge programs for them. And there are also no income-driven repayment plans available for the most part. So this can mean monthly payments can be very high, and borrowers may have no real options for that if they're unable to repay them. Next slide, please. Okay, so the last thing I wanted to discuss was bankruptcy for student loans. Just wanted to provide the disclaimer first that I'm not a bankruptcy attorney. This is a very complicated topic, and anybody looking into bankruptcy for student loans will definitely need a bankruptcy attorney. But I just wanted to give a general overview. This is another thing that I believe will maybe become a more important option going forward. So federal and private student loans are dischargeable in bankruptcy, but it's quite difficult compared to discharging other kinds of debt. So as opposed to other forms of debt, to discharge student loans, the the borrower must make a heightened showing of undue hardship. And there's different standards for this in different courts, but to summarize the standard, it means that they wouldn't be able to maintain a minimal standard of living if forced to repay their student loans, and also that the situation is unlikely to change. Some courts also require evidence that they've made a good faith effort to repay the student loans. So that could mean applying for payment plans, or making a bunch of payments before being unable to pay. But this is a difficult standard to meet, and especially before 2022, this was very difficult to meet. So the rationale behind these heightened standards was the worry that students would complete an education program preparing them for some high earning career. For example, they would complete medical school, and then they would declare bankruptcy to get rid of that debt, and then they would just start working. So that's the concern that this heightened standard was targeting, but in effect, it's also ended up making lots of people unable to receive bankruptcy discharges of their student loans, who are not benefiting from their education, who maybe attended some school and were never able to use their degree. So in 2022, the Department of Education issued guidance to government attorneys about student loan bankruptcy discharges, and this was a pretty complicated set of standards, but just to summarize, essentially they were instructing government attorneys to stipulate facts showing undue hardship in a wider range of cases to make it easier for borrowers to receive bankruptcy discharges of their loans. So it's still a heightened standard, but under this guidance, it became a lot easier than it was before. So it's unclear whether the current administration would seek to change this guidance. But as of recently, I have still been hearing from colleagues that this guidance is being followed by government attorneys, and that they're still stipulating to these facts. Okay, so that's it for me, and I think I will pass it to Khandice to discuss state level programs.
Milo, that was great. Thank you. Now, Khandice, see if I can give you control. Take your cursor around in a circle, push down.
Okay.
Try moving it with your arrow.
Okay, let me see. Move in a circle.
Push down.
Oh, push.
There you go.
Okay. Oh, okay. All right, we're in business. Great. All right, thank you. So, hello everyone. My name is Khandice Lofton, and today I will be talking about the state of student loans debt system at the state level. So I am counsel with the Student Borrower Protection Center, and we are a national nonprofit dedicated to alleviating the student loan debt burden for borrowers and also consumer debt in general. So Milo and Sara did a great job discussing how hectic things are at the federal level and just how uncertain times are. And we thought it was important to also discuss the work that's being done at the state level and maybe how your state officials can get more involved to help borrowers. Okay, so we'll go through a few things today. We'll talk first about why it's important for states to take action, about the ways that states are taking action, what states are doing this work, and how borrowers and advocates can get involved. So first is, why is it important for states to take action? A lot of people don't even know that states can take action about student loan debt. And it's extremely important that we share this information so that they do. So why is it important for states to take action? Well, the historical and constitutional oversight over financial services and consumer protection, it has not always been consistent on a federal level. And so it's important for states to step in and help their own citizens and their own constituents deal with consumer abuses and student loan debt abuses that could happen in the industry. Another thing is that state officials are close to the ground, and they are more accessible to policymakers, legislators, closer to the ground to borrowers and their own community. So it's important that because states is happening right there in their backyard to do something about it. The federal government can't or won't in this day and age, possibly they won't do it all, can't do it all. So it's important that states kind of pick up the slack there and help borrowers within their own states. um, and it's also important for states to provide extra consumer protection, civil rights, and just to provide their own constituents with economic mobility and stability. Um, as we keep reiterating throughout this presentation, times are uncertain, and so it's more important. It's now more important than ever to make sure that borrowers and consumers are protected. And just in general, this stuff is confusing. Like even for us experts right now, it is so confusing. Things are happening so fast and changing every day, and so we like to have as much protection and help from all sides as we can. All right, so what are the ways in which states can take action? Well, there's a few things. So first, I want to remind everyone that federal student loans are serviced by private non-bank companies. So these are your typical services that you are seeing. These are not student loan experts per se. States are the primary regulators for non-banks, so student loan servicers. Some banks are also state chartered, which also gives jurisdiction. And then not all student debt advocacy involves loans or even financial regulation. So when I go through a few of the legislation that we've worked on, you'll see that they don't always involve just the loans and the student loan debt. They may involve other ways to advocate for borrowers. So we have a few things up here that are ways in which states have taken action. So the Borrower Bill of Rights, private student loan registries and protections, ending transcript and diploma withholding and addressing institutional debts, and public service loan forgiveness expansion. And I'll talk a bit about each of these in turn. So first, the Borrower Bill of Rights. This is a law that we have worked on that regulates licensures, regulates and supervises private companies that service federal and private student loan debt. These laws protect borrowers from prohibited abuses and acts by servicers, to make sure that, for example, they are being informed about their student loan debt, to make sure that servicers are adhering to business standards and regulations that are set within these Bill of Rights, to make sure that they are properly licensed to do their job. All of this is done here. They also create a student loan ombuds person. This person is pretty much an advocate for student loan borrowers. They ensure that servicers are doing their jobs correctly, and they also help advocate for borrowers and help borrowers in the best way that they can. If they are having issues with their servicers, they try to find solutions and resolve those in accordance with this Borrower Bill of Rights. Student Borrower Protection Center, we have templates of this legislation that states have used to propose and end up passing in their own states to provide more protections for borrowers. That is the first one. Private student loans. So we have a couple different laws with private student loans. First set is laws that involve registries. So this is like a sunlighting law, an oversight law, who is actually engaged in student lending type of law. These laws make sure servicers register with the state, letting the state know that they are collecting student loan debt here, so that state attorney generals and people like who have the jurisdiction and power to regulate and check private student loans are able to do so much easier. So they register, and it allows for powerful data-driven policy making and increases consumer choice. The other is laws regarding debt collections and protections. So these address specific and documented abuses in the private student loan sector. And it mirrors certain federal student loan protections, but it provides that extra layer that we talk about. This also provides protections for co-signers and borrowers with disabilities and other contract protections, like Milo was stating earlier, like some private loans, you have to get a co-signer. So this adds an extra layer of protection for them too. It also provides debt collection requirements and protections against certain default judgments. So like Milo also stated earlier, private student loan servicers can take borrowers to court to collect sometimes. And it's important because borrowers sometimes may not know that they're being taken to court, unfortunately, and it can result in a default judgment that may force them to pay or have their wages collected upon. And so this provides extra protection for those borrowers so that they are not harmed by the default judgments. Transcript and diploma withholding institutional debts. So not all student debts are loans, and these are a great example. Transcript and diploma withholding occurs. Sometimes schools will withhold a student's transcript or their diploma so that they are unable to, say, go on to grad school and or go on to another form of job. They can't confirm that they received their diploma or their degree because the school may be withholding it because of a debt. This could be library debt. This could be parking tickets. Like schools have actually withheld these things because the student may owe a debt. And it may also be a student loan type of debt that went towards tuition, but sometimes it can be as little as parking tickets or library debts, like I stated. These debts have resulted in both judicial and non-judicial debt collection practices, unfortunately. And so laws that are being passed within these states are stopping these type of debts and making sure that schools are not withholding transcripts or diplomas so that students can go forward. Now, there may be limits on this. It may not be wholly prevented by the law, but there have been restrictions put in place to stop the diploma withholding and transcript withholding. Some states are limiting the non-judicial practices, like I stated before, document withholding, transcript withholding, so that students can move on from the school and pursue other ways of education or jobs. States could also address the root cause or rethink their approach to recruitment and retention strategies and institutional debts. So this, what we mean by this is just addressing what's going on at a granular level at the institutions. Been thinking about how there are other ways to retain students or to obtain the money that students may owe to their schools without withholding such important documents from students. Finally, we have public service loan forgiveness expansion. Now, Milo did a great job earlier telling you all what public service loan forgiveness requires on a federal level. It's the same at the state level, but these laws are expanding access to borrowers. And it's doing that by mandating a multiplier to be used to calculate hours worked for adjunct and contingent faculty. So I'll back up a bit. Milo earlier discussed how public service loan forgiveness requires you to work full-time for an employer. Now, full-time means 30 or more hours, or how your employer defines full-time. It doesn't matter what you're actually doing at the job, it just matters if it's full-time. Now, for some people, like adjuncts or contingent faculty, who may not necessarily be full-time, but put in full-time hours, it can be hard to show how many hours they worked versus how many hours that they are contracted for on paper. And so usually services are going to go off of what you are contracted for on paper. And unfortunately, that can leave adjuncts without access to public service loan forgiveness, even though they may be putting in the 30 plus hours of work as professors. So the PSLF multiplier here allows usually schools to, services to apply like 3 times the hours that are contracted for adjunct professors so that they can earn credit toward PSLF in a way that they otherwise wouldn't be able to. This law is a fairly new one for us that we've been working on, but several states have been on board with proposing and actually passing these laws so that more workers and borrowers are able to access public service loan forgiveness. And it's been a big help for folks. Like Milo said, PSLF has not been administered in a great way in past years, but we are hoping that this can help a lot of borrowers. So if this is you, you may want to look into your state to see if you're able to access this and take advantage. So next, what states are doing this work? So I have a few maps here, and I'll leave this up for a second before going to the next, but these are states that have enacted Borrower Bill of Rights. Those states are in blue, solid blue. States that are making efforts to pass Borrower Bill of Rights are in the stripes. It's maybe not as clear right now, but they're actually like stripes covered there. So these are states currently doing this work or that have enacted this law, and we hope to get some more on the books soon. These are the states that have enacted private student loan registries or protections and debt collection court reform type of laws. So states, again, that are in solid blue, they have enacted these protections. States that are stripes are putting in effort to pass protections for borrowers. And then the ones kind of orange striped are ones that have enacted some protections already. Maybe they already have a private student loan registry in place, but they are working to add more collections so that borrowers are not being collected for default judgments. So those are states that are adding to their protections. Transcript and diploma withholding and institutional debt. Again, these are states that have enacted laws that prevent schools from withholding diplomas and transcripts for maybe small arbitrary debts. Bills are in solid blue, and then those who are making efforts to enact protections are in the blue stripe. Finally, public service loan forgiveness. These are states that have done this work. Solid blue, again, they have enacted protections or enacted this expansion to allow borrowers who maybe would not access PSLF otherwise to have that access. And then those with stripes are making efforts to pass the expansion. So finally, how borrowers can get involved, what you can do if you saw your state highlighted or if you didn't. So you can reach out to local and state leaders or officials about instituting these protections and these laws. Borrowers and people alike often forget how much power you have and how much calling or emailing your local officials can really make a big impact if enough people are doing so. So calling them and asking about these laws that may or may not be in place and are encouraging them to advocate for it and maybe propose legislation, you could do a big thing there. We also have SPPC, we have a congressional casework tool. If you're having issues, you can use this tool to reach out to your local, state, and federal congressional members to talk with them and to get more involved in that level. Testifying at hearings. We've often helped borrowers prepare testimony at hearings about these laws and how important they would be to the borrowers. Legislators love to hear from the people. and not just experts about how important this is to them on a real level, and how this could really affect their finances and help them. So if you have an opportunity to testify at a hearing, you definitely should do so. Keep in touch with us. We often post a lot about hearings going on. And then finally, follow us for more information. Shameless plug here. We do a lot of this work, like I said before. We have a lot of updates that we post on our social media websites. And so if you're interested and you want to keep up with us, be sure to do so. Things are hectic, things are uncertain, they're changing every day. We try to keep things as updated as possible for you all. And then a couple resources, state ombudsman list. These are, again, your advocates, people that are there to help borrowers specifically. So we have the list there that you can reach out to get help about your loans. And then the congressional casework tool that I mentioned earlier, there's a link to that as well. I think Linda said earlier that we'll be sending our slides out in about a week, so all of this will be there still. So thank you. Thank you all. That's the end of my presentation.
Well, Candace, thank you. That was awesome. Let me now turn this over to my colleague, Nelson Santiago. All right, audience, it's time to hear from you. Let's get those questions over to Nelson. Nelson, can you take over from here?
Yes, Linda, thank you. And thank you to the speakers for those great presentations. We do have a few questions here. Let's see how many we can get in before we have to close. One of the participants told us that they spoke to a student that recently said who told them that they had recently gotten help from a company to have their student loan completely erased because of the original loan contract was breached by the Department of Education. That sounds like a scam, doesn't it? Is the question.
Sure sounds like a scam to me, because those are the stories that we hear all the time from borrowers that are showing as delinquent on their student loans according to NSLDS and their loan servicer. And when we get them on the phone, we hear, no, I already paid somebody. They're taking care of everything. I signed all this paperwork. And then that company ran off with their money.
Okay, so be wary. Thank you for that.
I will say I can't say with certainty, but it does sound like a scam.
Okay. Yeah, we always talk about, recognizing the red flags, right? So got to investigate more. Yep. if you really think you need to. The next question. After the processing of a forbearance, when you're moved into the general forbearance, does anyone know if that time in the general forbearance would count against the 3 years a borrower gets for forbearance?
My understanding is it would not, because it's not a discretionary forbearance that the borrower is enacting. It is being put on place because of the delay in processing. I don't know if Nelson if Milo or Candace, if you have anything to add to that.
Milo can go, but I think that's right. It has to be you that started the forbearance.
Okay, excellent. We have a couple of questions here related to veterans. The first one, it says, someone on VA disability who gets TPD said some of the disabled vets that I have spoken with, says the person asking, actually do some work. Is there a possibility of them losing their TPD status if they work full time? And if we need to research this and get back to folks, that's fine too.
Nelson, why don't we do that? Why don't we take that particular question and do some research and get back to everyone?
Sounds good. Thank you. Another one here regarding from an organization that serves veterans. I'll just read you the questions. We have had some veterans who have used their VA education benefits to go to school. Unfortunately, after their education benefits were disbursed, they had to drop out because going to school was too much for them due to PTSD, for example. Yet they had to pay back the full amount of funds. Can anything be done for the schools to return those education funds if a veteran dropped out of school due to such situations?
I'm not sure about this one, but I think that we can also follow up because we have some veterans resources, but that's not my area of expertise. I don't know if Milo or Sara.
Okay, great. Yeah, we'll be able to contact this person later if we look into it some more. Sarah, I think you talked about misinformation earlier about some of the things that you've heard. Are there particular types of things that people may be hearing more of? And is this kind of incorrect information being heard from what are quote unquote reliable sources, but perhaps they don't understand the complexity of things, or why is there so much incorrect information being put out? And what can we expect now? Or will we expect more?
Great question. And I think a lot of it is just the unprecedented times. With COVID, there was a payment pause on student loans. We'd never seen anything like that happen before. And so as the resumption of payments happened and, there were some, policies put in place to help, protect borrowers to an extent and make sure that, we didn't just resume repayments and have a bunch of people express default. A lot of that is, I guess, there is accurate information out there, but because it's never happened before, there's a lot of nuance that is maybe uncertain. And so I think that it's when you get into the nuance and the details where somebody might be reporting what they think is accurate, but the reality is that it's not the way that it's going to actually manifest from a servicer's perspective or the direction that the servicer gets from the Department of Education. Between that, the resumption of payments, and then also the kind of the news sensationalization of this level of mass forgiveness. As soon as it was pursued to have some level of broadened student loan forgiveness, I think a lot of people's hopes were heightened. Their hopes were high, and so that idea of, oh, there's an opportunity where I could have my loans forgiven, that hope is easy to latch onto. And then therefore, with that hope in mind of I'm not going to have to repay back my student loans, it's easy to be susceptible to the information that aligns with that statement. And a lot of that has changed. Even just talking about the court cases, with every court ruling, there's a little bit of difference in how it's being applied. And so I think that's really the biggest source of misinformation, is just that it's been an evolving, ever-changing situation, and the dust hasn't settled yet. I mean, we have a ruling on SAVE, but I think devil's in details. Once it starts playing out and becoming policy, there may be further cases brought up, either to encourage the Department of Education to take action or to stop them from taking action, depending on what it is.
Thanks so much. Yeah, it's an important topic. And people, watch your inboxes, audience. We will be having a webinar on on determining what is real news and not real news. So it's a good thing to learn more about. Another question here is for borrowers who are on SAVE and wanting to resume payment, is the recommendation to go with IBR given it's directed under statute rather than executive action? Although then they're asking about the caveat regarding interest capitalization. Is there any way to avoid the capitalization like SAVE allowed?
That's a great question. So I think that is a I would hate to give kind of a global advice there because I think it really just depends on the borrower's situation. So if a borrower is in SAVE, they should consider other repayment plans. The benefits that were just mentioned about income-based repayment, that from a statute perspective should remain because it was enacted by Congress. However, given that individual borrower circumstances and the potential of capitalization, they really need to take that into consideration in their unique circumstances. And I think the best advice I can give is to contact their loan servicer.
I believe there's still tools online that people could use to see how much their payments would be under each plan. These are not always accurate, but that could also be a way for you to gauge what the best repayment plan is for you. But like Sarah said, I agree. We can't really tell you what's best for your particular situation. That's case by case, but there's tools out there that can help you figure it out for sure.
Yeah, I think they're still in the process of updating the loan simulator now because I think as of the last time I looked, it's been a few days, it was still showing SAVE. So just kind of keep that with a grain of salt. Like there are tools out there that can help you evaluate your options, to Khandice's point.
Great, thank you. And then do any of the panelists know if staff reductions at the Department of Education have impacted their ability to help student borrowers or work or help lenders, even work with lenders?
I mean, I can't speak personally. I know, I'll just say from my perspective, some of the people that I worked with directly to get questions answered when, I had confusion or needed clarity, are no longer there. But on a broad scale, I don't know how that's impacting borrowers. I do know that the majority of borrowers contact student loan servicers, but we already knew that reduction of staff at student loan servicers and reduction of hours was leading to long hold times there and delays in getting help.
Here's a quick question on PSLF. Is it 120 on-time payments? Are they consecutive or cumulative?
They are not consecutive, they're cumulative, but I'm going to ask Milo and Khandice to confirm that for me because that's not.
That is correct. So you can start making payments in the PSLF, you can go into the private sector, and you can come back 3 years later and continue making payments with PSLF if you go work for another nonprofit. It's cumulative. Yep.
Does any
And I know Milo's having some microphone problems, but he did answer that as well.
Yeah.
Thank you, Milo, for chiming in however you can. Someone's asking about, are there any updates? Is the SBA going to take over student loans at some point? Is that really expected to happen, or no news?
I'm not one for predicting the future at this point. I think that until things happen, it's really anybody's guess.
Okay. And somebody's telling us that one of their clients received a letter stating that their student loan was forgiven because the school was not accredited. Is there a way to get information on that? Is that something are those kinds of letters going out?
I know on a case-by-case basis, I can just say that I am aware that there have been loans that were forgiven in more of a unique circumstances that weren't like a broad, applied to all borrowers, but more specific to a school. So it's possible that a school might have been found to legally not be able to do that, and therefore the borrower's loans were canceled or forgiven. But it is a case-by-case basis. I don't know if Milo or Khandice, if you have anything to add there.
Yeah, if you know your servicer, I would check with your servicer. I would check with the Buds people that we showed you earlier. Sometimes you can Google the school. There may be an actual lawsuit in place that did, result in borrowers having their loans forgiven because of the school not being credited or being fraudulent. But I would look into that, one of those ways.
Great, thank you. And let's we'll go to the audience and speakers. Let's go over just a couple of extra minutes and see if we can squeeze in a couple more questions. Somebody here is asking, if we work for a qualifying public student loan forgiveness employer, but may be affected by the recent executive order to redefine qualifying employers, should we still submit the PSLF form to submit qualifying payments, or should we wait until this administration leaves office to certify all qualifying payments at once? For example, 4 years of qualifying payments versus submitting the form yearly.
Yeah, there has been no changes to PSLF. I think Milo made that point, and he made it again in the chat. I'll reiterate, there have been no changes to PSLF at this point. So yes, you should submit it. The only thing the executive order did was ask for the rulemaking that Milo discussed to happen. So there have been no changes to who's the qualifying employer yet. Submit those forms, get those in, and get your qualifying months in. Yeah.
Great, thank you. Someone says that they had a student loan that was defaulted over 15 years ago. Now they're totally disabled. Can they apply for disability to get the loan forgiven?
I can say Milo's answer. He said that it is available for a defaulted loan. He believes it's available for a defaulted loan. So again, possibly check with your servicer and see about putting in an application for that.
Thank you so much. The next question here, the CFPB took action against Climb Investco for providing loans to unaccredited schools. Will those automatically be discharged? Is there anything automatic in those kind of situations?
Sometimes they are automatic if the lawsuit's been completed. Not sure, the Climb lawsuit I think was completed, but that was before the whole disbandment of the CFPB. Those are usually automatic though. If it hasn't happened yet, stay on top of your servicer and stay on top of the lawsuit. But yes, those, I believe those are automatic when they happen. They can take a long time.
Great. Another question about Parent Plus loans. Do those ever qualify for public service loan forgiveness?
Those can apply. Yeah, I think Milo said not sure either. We haven't, so we have like had people consolidate to try to get their loans to be direct and apply it for PSLF with Parent Plus loans. But right now, like I think it was Sara mentioned earlier, consolidating may not be a great option for anyone right now. So we're just not sure about those.
Okay, great. And then
Yeah.
oh, sorry, go ahead, Sara.
I was just going to say, there's an article on studentaid.gov that I will drop in the chat if I'm able to send that to everybody, or I'll just send it to you all and you guys can share it in the follow-up that talks about the PSLF and Parent Plus loans.
Yes, in a week, we will be sending everyone the slide deck, link to the recording, and any handouts, articles, etc., that you'd like us to add. Maybe anything that might answer some of the questions that we were just covering now that we didn't have the answers to right away. I'll just ask, I don't know if this is a quick one or not, but someone is saying if your IDR is $10 a month, which is lower than a standard payment, does that mean you don't get credit toward PSLF? Is that a Milo question? Or
So Any IDR payment qualifies, even if it's a $0 payment a month. It would, if your income-driven repayment plan sets your dollar amount, your monthly payment amount at $0, then you are effectively making a payment every month that you pay $0. So if whatever that payment amount is and you pay it, that's a qualifying payment.
Yep.
Excellent. Okay, well, why don't we wrap it up? There are a few, some sort of like, small questions like that I think we can put together and share with the panelists and try to get people answers or links, etc., for more information in about a week. If you have had any other final thoughts, panelists, feel free to throw them in now. Otherwise, I'll just hand over to Linda.
Well, Nelson, I have one quick question. I think it's a Milo question. One I was waiting to hear, but no one asked the question. A while ago, those seniors who raised their grandkids and signed for their grandkids to get student loans were having their Social Security checks garnished for if they went into default for repayment. And Milo mentioned something about the SSA disability discharge. Is that available for those seniors out there who probably who are getting Social Security and probably have defaulted on student loan? So that's the question that I have. I guess we can get it answered later on, because I know there's a lot of CBOs out there that represent seniors. Okay.
Milo did answer when he said if they are Parent Plus loans. Yes, I believe that Social Security TPD discharge would be available for them.
Oh, great. That's good to know, CBOs. That's good to know. I'm going to join Nelson in thanking all of our great speakers for fantastic presentations. Now, if you would like to contribute to Consumer Action, there are several options available for you to do so. You can sign on to our website, and the website is there on the screen, www.consumer-action.org/giving, and you can make a contribution via a credit card or PayPal. If you like, you can mail us a check. We take checks, and you can use the address below. Mail the check to Consumer Action, Attention Membership Given, 57 Post Street, Suite 708, San Francisco, California. Another way to support us, another option is to support Consumer Action by subscribing to our YouTube channel and following us on social media. By subscribing to our channel, it is completely free, and you will stay updated with our latest content, and we will receive a notification anytime we upload any new information. When Nelson sent out the PowerPoint slides, you can click on that little link or cut and paste it, and you will be able to subscribe to our YouTube channel. As we conclude our training today, again, I want to extend a heartfelt thanks to our special guests, speakers, for their invaluable contribution. You rock. So great presentation. If you have any further questions, audience, please feel free to email me at linda.williams@consumer-action.org or to nelson.santiago@consumer-action.org, and we will get those questions to our guest speakers and the answers to you. Before logging off today, please complete the survey. It would help us improve future sessions. And for those of you who need the AFCPE password, it is Navigate. Yeah, it's Navigate. Thank you once again for joining us, and we wish you a wonderful rest of your day, and see you next time.